By the way, good evening, everyone. Welcome to part 2 of this bonds. And we're going to start off tonight, all right, with going to the book and going to page 2H25. 2H25, all right, 2H25 on the top. And it says, all right, if Sonny will bring up 2H25 on the top.
Mm-hmm.
Did anybody shoot? Oh, there he is. Hello.
No one shot me. It just took me a second.
It took him a second. Okay, here we go. All right, a little lower, Sonny. There we go. All right, some bonds carry a conversion feature. All right, so what we're doing here is we're retiring bonds and converting them to stock. Now, why might we carry? Why might we retire bonds and just convert to stock? All right, because of this reason. All right, at the time we actually issued the bonds, maybe the rates were really low. All right, but then when we compare the rates of the present bonds we have, all right, they're much higher than the market rate. So we might want to just retire the bonds and give common stock to the stockholders. Do you see that? And this feature is stated in the bond contract. All right, do you understand that? When I issue bonds to you, there's a contract that I, the corporation, am borrowing money from you, and at maturity, I will give you the face amount of the bonds, okay?
Mm-hmm.
All right, so there's 2 methods of converting bonds to stock. One is called the book value method, and the other one is called the market value method. Now, under the book value method, all right, what they're doing is they're going to take the book value of the bonds. Now, the book value of the bonds is the carrying value, okay? It's the carrying value, which means it's the bond payable, all right, less the unamortized discount or plus the unamortized premium. That's the carrying value. Now, we're going to make that equal, all right? We're going to make that equal the common stock, all right, also at the book value of the bonds. So let's take an example of this. And by the way, it makes no difference whether the book value method, if the stock was originally issued at a premium or a discount. It makes no difference. All right. So it says here, again, assume the bonds originally were issued at a premium and they're retired early through open market purchases. Remember what open market purchases are. That's the date they can buy it back. Okay. All right. But in this case, the stock price has risen and made it more advantageous for the bondholders to convert their debt holdings to equity, to stock. The open market purchase on December 31st, 20X1, immediately after the relevant interest payment, and when the market rate is 98 follows. All right. So here is a relevant portion of a bond amortization table. It's partially. All right. Now notice the bonds are issued on 11X0. All right, they were issued at a premium. All right, why? The face amount of the bonds is how much?
100,000.
100,000. All right, so we issued at 108,111. Now, what we're doing here is we're going to amortize these bonds, and what we're going to do is, first of all, the interest payment is 5,000, and that would be based on it's semi-annually, so they must. The annual rate is 10%. Would you agree with that?
Yes.
All right. Because semi-annually be 5%, correct?
Mm-hmm.
All right. So every 6 months, they're going to pay 5% of the face value. We said the face value of the bonds was 100,000, right?
Mm-hmm.
All right. So 5% of 100,000 is 5,000. All right. Now, the interest expense is calculated by taking the yield rate. All right. Somewhere there's the yield rate here. I had it the other time, but don't worry about it, okay? How would you calculate the yield rate? Just tell me. First of all, it's given. How do you calculate the interest expense?
It's not the stated rate times the face value.
No, okay?
It's expense.
The cash payment for the interest is the stated rate times the face value.
Okay,
that's the 5,000, all right?
Okay,
How do you calculate the interest expense?
The interest payment minus the
No. What rate do you use?
The yield rate.
All right.
You use
the yield rate, right? For 6 months times what?
The carrying value.
The carrying value, all right, which would be 108, 111. Do you see that? All right, that's how you get the interest expense. So that's 4,324. Now remember, these bonds were issued at a premium, right?
Yes.
All right. So the amount of the premium that's amortized is the difference between the cash payment and the interest expense. Or to put it another way, what is the expense to the corporation for issuing these bonds? All right. It is made up of the what? All right. The cash payment, the interest payment, right?
Yes.
Now, this was sold at a premium, right? So at the issue date, all right, the corporation got how much? $108,000, right? Roughly.
Right.
And at maturity, how much are they going to pay back?
100,000.
100,000. So let's think about this. Is selling bonds at a premium good for the corporation? They're getting 108,000 at date of issue, all right? And then at maturity, they only have to pay what? 100,000. All right. So that's like additional revenue, isn't it?
Right.
Think about it.
Yes.
It's additional revenue. All right. So when you amortize that premium, all right, it should do what to your interest expense?
You should decrease it.
All right. It should decrease interest expense, right? Because it's like additional interest income. You're getting more money when you sell it, and you just have to pay back the face amount at maturity. So when you amortize bond premium, you debit bond premium and you credit interest expense. All right.
Yes.
All right. Some people credit interest income. That's not really right. It's the same thing, but you credit interest expense. So the interest expense should be made up of what? All right. The interest payment you make of 5,000. The amortization of the bond premium is going to do what to your interest expense?
Increase it.
So bring it down.
It's going to bring it down, isn't it?
Yes.
All right. So look here. The interest expense is 4,324. That's made up of our interest payment of $5,000 less the premium that's amortized, which is like additional interest income to you. So really, instead of having an interest payment of 5,000, which is interest expense, by getting the fact that you amortize the premium, which means you got more money, you just have to pay back the face amount. The amortization of premium reduces your interest expense.
Okay.
Anybody see that?
Yes.
Okay. Now, the journal entry, all right, we're doing the book value method here. The journal entry, we're going to convert 100,000 shares, $1,000 shares to 10,000 shares of common stock, each share with a $1 par value. All right. So what we're doing is we're taking the book value of the bonds. All right. And when are we doing this conversion? On what date?
The end of the year.
Yeah, 12/31/X1, right?
Okay.
All right, so we have to get rid of the bonds. All right, now, what are the bond balances at 12/31/20/X1? How much is the bonds payable?
106.
That's first of all, that's 6/30/20/X1. 100,000, right? Isn't the bonds payable 100,000?
Yes.
All right, and it's 105,242, the carrying value. So therefore, there's an unamortized premium of 5,242. Do you see that? Yes or no?
Yes.
Yes.
All right. So what are we doing? We're retiring the bonds at their carrying value. All right. Well, to retire a bond, you debit bonds payable. All right. Premium has a normal balance of debit or credit.
Credit.
Credit. So to get rid of it, you debit the premium. Okay. All right. Now we got to take the carrying value of the bonds we're getting rid of.
Kids.
Is that your kids? What do you? I'm going to come get those kids. All right, now. All right, mute your microphone if the kids are on. Okay. All right. Can you do that? All right. Anyway, next thing. All right. Now we're going to take the book value of the bonds, which is 105,242, and we're going to convert it to common stock. All right. So what do? We credit common stock for the number of shares of stock that we're giving. How many shares of stock are we giving? All right. How many shares of stock are we getting by converting
10,000.
the bonds to 10,000, right?
shares.
10,000. And what's the par value per share?
$1.
$1. That's a $10,000, right? So what's my plug figure? All right. Additional paid in capital and excessive par for common stock, 95,242. So notice there is no gain or loss on conversion here. Why? Because we're converting the book value of the bonds to equal the book value of the common stock. Okay? Does everyone see that?
Yes.
All right. Now, we also have another method, which is called the market value method, all right, which appears on page 2H26. So if we go to page 2H26, all right, let's see what we're going to do here. All right. Now, here's the market value method. A gain or loss is going to occur. Why? We're taking the carrying value of the bonds and converting them to the fair market value of the common stock. Okay? All right. So notice, there's no numbers here. Notice, all right, to convert the bonds to the market value method, we take the we take the book value of the bonds. The book value of the bonds are made up of their bonds payable plus their premium. Do you see that? So we debit the book value for the bonds payable, the book value for the premium. That's the carrying value of the bonds. All right. Now, we issue the stock at what value? Par value,
One
right?
far, yeah,
Mhm.
All right. Now,
dollar.
get the common stock for paid in capital excessive par. What are you doing? You're converting the bonds to common stock at market value. I'm sorry. Let me repeat that. You're converting common stock to market value. So therefore, whatever the par value is, subtract that from the total market value of the common stock. And now we'll give you the amount that you actually credit to common stock paid in capital excessive par. Do you understand that? All right.
Mhm.
All right. I'll show you a question on that, but well, they don't, honestly, they don't have a question in the back on that. But notice with the market value method, you can have a what? Gain or loss on redemption. Do you see that? Now,
Mhm.
why is that? Because the bonds are at book value. All right. The common stock is being converted to its market value. So there's difference, right? All right. So whatever you need that difference, one, we're debiting book value. All right. And then we're crediting the common stock and the APIC excessive par for market value. All right. So the difference is going to be either a gain or loss on redemption. Okay. Has
Mhm.
everyone got that?
Yes.
Yeah, I
All
have a
right.
quick question, Phil.
Yes,
So-
go ahead.
On the exam, they will just tell us probably you're using the market value or book value.
They're going to, first of
Converting
all, you have to have the carrying value of the bonds. Okay. All right. You got that?
Mhm.
Now, what they could do is they could tell you that the balance in the unamortized premium, all right, at 12/1, 20x1 is so much. And then they'll say the balance of the unamortized premium at 12/31x1, the date of the redemption, all right, is this figure. Don't forget, when you write off the premium on the bonds, you write it off at the date they're redeeming the bonds. You got that? Yes or
Mhm.
no? Watch
Yes.
that. Now, bonds payable is not going to change. It'll still be at the face amount. Okay? All right? Now, you're going to credit common stock. Common stock is always credited at what value? Par value or stated value, right? All right.
Mhm.
So you take the total par value of the common stock. All right. Now you subtract it from the carrying value of the bonds. And the difference is what? All right. The gain or loss on redemption. You see, they got to give you, all right, first of all, you got to have the carrying value of the bonds. All right, that's the bonds payable plus the premium or less a discount. All right, now they got to give you the fair market value of the common stock you're converting to. The fair market value of the common stock is equal to the par value less the total fair market value of the par value and the APIC. What makes up the fair market value of the common stock? What two amounts?
Par and
Mhm.
Par and the additional paid in capital excess of par, right?
Mhm.
Those two amounts are the market value. So really, you know what the par value is because they'll tell you. So therefore, all right, if they give you the total market value, all right, you have to take the total market value of the common stock less the total par value, and that gives you additional paid in capital in excess of par. And then what's your plug? Gain or loss on redemption. Do you see that?
Mhm.
Yeah.
Okay. All right.
So, I mean, basically, Phil, if you can do this journal entry, you'll know whether it's a gain or loss because you need your journal entry to balance.
Well, yeah, you can't determine if there's a gain or loss unless you make a journal entry, right?
Right. Yeah.
How do things get into your general ledger?
I like those.
You make general,
I like. I just said 5 minutes ago.
So we gotta measure how wide it is.
I don't care.
journal entries, and then you put them in loss unless you really make the journal entry. The gain or the loss is the difference between the market value of the common stock. Am I frozen?
We gotta measure.
No.
Sonny, can you book back the page?
Yeah, you're back, Phil.
Yeah, but can you put the page back a
Yeah,
second?
there you go.
Okay, all right. Go down, 1231X1. Tell me, what's the total, all right?
Are you guys did not eat anything?
What? All right. If you're going to, please, if you're speaking at home, okay, put it on mute for the other people's consideration, okay? I want to go over this again, all right? For the market value method, what are we converting? We're converting bonds to stock, correct?
Mhm.
All right, but we're converting what? The carrying value of the bonds payable plus the premium less the discount, all right? And we're converting that into the common stock at fair market value. Now, the common stock at fair market value is equal to the common stock at par plus the additional paid in capital in excess of par. That's the total market value. So what's your plug? All right, the difference between the carrying value of the bonds, which is book value, all right, versus the total fair market value of the stock, that's the gain or loss. All right. By the way, what type of account is loss on redemption of stock? Ordinary, extraordinary, what is it?
Ordinary.
Ordinary.
Mhm.
Remember, there are no extraordinary gains or losses, right?
Mhm.
All right. And then it just says under these two journal entries, the debit or credit to the loss gain in both the above journal entries is for the difference in the market value of the stock of bonds. Well, it's generally the market value of the what? The bond. Well, it's the market value of the stock that you're converting to. All right. And the book value of the bonds. Do you see that? The loss or gain is recognized. Note in reality, the conversion will never take place. The market price of the bonds would adjust. If the market is efficient and the investor would simply sell the bonds, avoiding the additional transaction costs or commissions involved in the conversion. So what they're saying is this: if you have bonds, all right, that are not paying the yield rate, all right, what are you going to do, all right, as an investor? All right, you'll sell those bonds, right? All right, you're not going to convert them to common stock. All right, you just sell those lower interest rate bonds that you'd be getting, and you do what? You'd buy higher interest rate bonds. All right, that's actually a conversion, but it's not. It's just a conversion of what? One bond to a better bond with a higher rate of interest. All right, now that's more theory. They just want you to know how you do this thing. That's the key thing. All right, let's look at some questions on this, if you would. All right, I have here, all right, let's go to multiple choice. Bear with me a second. All right, let's go to multiple choice. I wrote it down here. Where is my book value thing? Bear with me a second. Good. All right, book value, book value. All right, and I have question here. Let me go to the back and I'll tell you the question. All right, the question we'll do is, it's 180 something. Let me find it. All right, let's go to page MCQ 2-32, and it's multiple choice 183. Do you see that? Okay. All right, now 183 says, are you ready?
Yes.
On January 1st, Stunt Company, imagine that company, Stunt. Okay, obviously the profits are going what? Down. No, that's just a joke. Wasn't worth mentioning. Forget what I just said. All right, now let me get to the here. All right, now. So anyway, we have the Stunt Company. They had outstanding bonds with a face value, all right, of 1 million. All right, and unamortized discount of 100,000. On that date, the bonds were converted into 100,000 shares of $1 par value stock. The market value on that date was $12 per share. You see that? Now, it says the transaction will be accounted for with the book value method, okay? All right. By what amount will Stunt's stockholders' equity increase as a result of the bond conversion? All right. Now, let's make the entry. Take a piece of paper. All right. We'll make the entry. All right. You have a piece of paper? All right. First of all right, we're getting rid of the bonds, right? So therefore, to get rid of the bonds, we're going to get rid of the book value of the bonds and convert it into the book value of the common stock. Do you agree?
Mhm.
All right. Now notice they gave you the market value of the stock at conversion, didn't they? All right. Are you going to use that $12?
No, they give you par too,
No.
though, right?
No,
No,
they're counting for it at book value. All right. You'd only use the market value if they asked for the market value method. So the $12 is just to throw you off. You see that?
Yes.
All right. All right. So therefore, let's make the entry. We have to get rid of the bonds payable. How much are the bonds payable?
$1 million.
All right. So what are we going to do with the million? Debit, credit,
Debit.
debit
Or
bonds
debit.
payable for $1 million. Good. All right. Now we have an unamortized discount of 100,000 on the date of conversion. All right. We got to get rid of all of that discount, right? So what are we going to do? Debit or credit the 100,000?
Credit.
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 Credit the unamortized discount of 100,000, right? All right. So therefore, the book value of the bonds is how much? 900,000, isn't it? Isn't that the carrying value? Right? All right. Now we're going to convert that into the book value of the common stock. All right. So there's not going to be any gain or loss on conversion. Okay. All right. So now we're going to credit common stock. All right. How many shares of stock are we getting?
100,000.
100,000 shares of common stock. We'll credit common stock for how much?
100,000.
100,000. All right. Now what's the plug to make this entry? Balance. What?
900.
800,000.
800.
800,000. All
Yes.
right. So we have here bonds payable $1 million. All right. Discount 100,000. That's 900,000, right? All right. And why do I have here for the answer B? Hold on 1 second. I think it should be 800,000. I think that's a typo. Let me see here. All right.
No, because you have the 100,000 in stock too. In common stock.
Well, we have here. All right. All right. I'll tell you. All right. We have to debit bonds payable $1 million. This is on page MCQ 294. We credit the discount for 100,000. So that's 900,000. We credit common stock for 100,000, right? All right. So what's the plug to the entry? Additional paid in capital, excessive part for how much? 800,000. All right. So the answer is not. All right. Answer B should be 800,000. That's a typo. Okay. All right. For those who, let me just repeat that. Question 183. The correct answer is B as in boy. All right. And it should not be 900,000. It should be 800,000.
Okay.
Okay.
But isn't, real quick though, so 800,000 is the additional paid in capital, but you still have the 100,000 of common stock.
Right.
So that's, so I think
Right.
900
But
is.
what's the entry? Debit bonds payable $1 million, credit discount 100,000, right? What's the
Yes.
carrying value of the bonds?
900,000.
All right. Now we got to make the carrying value of 900,000 equal the carrying value of the stock also
Oh,
at
got it.
900,
So
right?
additional paid in capital is only 700 then, or,
No. We
No, it's
credited
900.
common stock for 100,000, right?
right?
All right. So if we have bonds payables $1 million, less the 100,000 gives you a carrying value of the bonds of 900,000,
Mm-hmm.
and our common stock is what?
100,000,
100,000. What's the plug to make the entry balance?
800.
800. There's no gain or loss here. Why?
Because we're doing it at book value.
We're doing it at book value. All right.
Mhm.
Now, let's see if we did this at fair market. They gave us the fair market value, didn't they? All right. let's do this at fair market value. They gave it to us. All right. If this was the market value method, what would you do? Oh, they want to know what's the increase in stockholders' equity. We didn't get
Right.
the answer. All right. What's the increase in stockholders' equity?
900,000.
900,000.
900,000. So that's why B is the answer.
Yeah.
You know what? I thought the answer was to APIC. I'm sorry. All right. Let me go back here again. We're taking book value of 900,000. We're converting it to common stock of 100, APIC of 800,000. The two stockholders' equity counts are the common stock of 100 and the APIC of 800. So the answer is B, $900,000. That's correct.
Okay.
All right. I didn't mean to confuse you. Do you see that now?
Well, that's
Yeah.
because common stock and APIC both increase equity.
That's the total equity of the corporation.
Yeah.
Now, they could have asked it this way. All right. What is the increase to APIC? That
Right.
could be another question they could ask.
Mhm.
And then your answer would be what?
800,000.
800,000.
Mhm.
Just remember there's 4 magic letters when you read a question. It's RTFQ. Did I ever tell you that one? RTFQ?
Read
It
the
stands for
blank check
read the question.
Read the funny question.
Read the funny question.
Mhm.
We'll go with that.
And by the way, you know who taught me that?
No.
Jim Bora.
Oh, really?
Jim Bora was a guy who ran a review course in the Baltimore area.
Mhm.
All right. And Jim was one of my teachers when I took CPA review. And he was he taught business law at the time. And I remember, and he also taught some taxes. But Jim would come up with these jokes, which were outrageous, like oh God, this was the joke. All right. He was teaching a medical deduction. So he said, he gives, the AGI is so much. And back then, I think the medical exceeded 7.5% of AGI.
Mhm.
All right. So he said, all right, this was the question. All right. Bill went into the hospital and had a pancreatic colon cancer situation. All right. All right. And this were his bills. How much can he deduct? All right. And Jim, with his sick mind, says he can't deduct anything. He died. All right. That was Jim. No, he was a good friend of mine. All right. So anyway, he was sick, but he was a good friend. Okay. Now let's go back to the text, please. All right. Oh, let's do the market value method. Okay. All right. Let's convert 183. All right. We're going to change it this way. The transaction will be accounted for by the market value method.
Mhm.
All right. By what amount will stunt stockholders' equity increase? All right. Let's make it this way. What amount will stunt have as a result of a gain or loss from the conversion of the stock bonds to stock? All right, this is another type of question. I changed the question. Now, if I said to you, they use the market value method
Mhm.
and they want to know what's the gain or loss on the conversion, okay? How
Mhm.
would we do that? All right, tell me the entry we would do. All right, we would debit first of all right?
Bonds payable. Mhm.
What?
Mhm.
Debit bonds payable, right?
Mhm.
How
Mhm.
much?
100,000.
$1 million. That
Oh,
doesn't
million. Yeah,
change.
million.
All
Yeah.
right. The
Yeah.
unamortized discount is credited, right?
Yep.
All right. For how much?
100,000.
100,000. All right. Now the stock is going to be $12 per share. All right. So they're converting into 100,000 shares
Mhm.
at par value, right?
Mhm.
All right. So we'll credit common stock for how much?
120,000.
100,000.
No. Par value.
100,000.
100,000.
Right.
All right.
Mhm.
But the market value was 12. So
Mhm.
therefore, we're going to have a credit, all right, to APIC
Mhm.
of what? All right.
1,100,000.
$2 times what? 100,000 shares is 200,000, right? Am I correct?
Mhm.
No, wait a second.
$2 is the APIC, right? In excess of par. All right.
Yeah,
So,
$2.
I mean, $12 is the market value.
$12.
All right. Yeah, I'm sorry. Let me repeat that. I said that wrong. Debit bonds payable $1 million. Credit unamortized discount 100,000.
Mhm.
Now we're converting it to the market value of the common stock. The
Mhm.
market value of the common stock is $12 per share. right?
Mhm.
All right. So $12 times how many shares?
100,000.
100,000.
100,000,
Mhm.
right?
Mhm.
All right. Now we're going to credit common stock at par value
Mhm.
for 100,000.
Mhm.
And all right, the total market value is 12 times 100,000. How much is that?
120,000.
120,000. So
Mhm.
therefore, the APIC should be how much?
It's just,
All
20,000.
right, we have $2 times how many shares? 100,000.
Mhm.
yeah.
Is that not? Let me see here.
No,
That should be
it would just be one, right, Phil? Because we take out the par value.
the par value is 1. All right. Oh, we're going to multiply that. The APIC is $11 per share, isn't it?
Right.
All right. All right. That's in between the 12 and the $1 par value. So you got
Right.
$11 times 100,000. How much is that?
1,100,000.
1,100,000. Now, does the journal entry equal debit bonds payable $1 million, credit unamortized discount 100,000, credit common stock at par 100,000, and the APIC is what? Is $11 per share APIC. That's the difference between the $12 market value and the $1 par. That's $11 times 100,000 shares is $1,000,001. Do you agree? All right.
Yeah.
Does that entry balance?
Now you need
No.
300,000.
You need 300,000. So you'll debit loss on conversion of 300,000.
There you go.
All right. This is the market value method.
Mhm.
You must have had this in school. Did you have this in school? Anybody? Did you
Yes, over and over again until we were going to throw up.
over and over again until what? I didn't hear what you said.
Until we were going to throw up.
You were going to throw up. That I didn't want to be in that class. I'll tell you something. All right, but anyway, that sounds disgusting. All right, now let's go back to the text. Okay, let's go back to the text, and I want to go to page 2K. I want to go back to. Hold on 1 second. 2K. What page am I on? All right, I'm on page. You know what? That was 2-20. I want to go back to bonds. Wait a second. All right. And we are on page. Okay. All right. We just did page 2H26, correct? What do we do? 2H26? All right.
Yes.
Now let's go to the top of page 2H27.
Mhm.
All right. All right. Now, GAAP is now more comparable to IFRS, which requires transaction costs, including, all right, third-party costs and creditors' fees to be deducted from the carrying amount of the financial liability and not recorded as separate assets. Bond issuance involves the following, all right, costs for printing, legal and accounting fees, commissions, advertising and promotion, and other costs, all right? These bond issue costs will reduce the net proceeds from the sale of these bonds, and effectively they'll increase the interest rate, all right? Why? Because bond issue costs are a cost of carrying the bonds. So therefore, your interest expense is going to be what? Increased. You agree?
Yes.
Okay? So it says here, therefore, these costs should be accumulated and amortized over the life of the bonds. All right. Now, let's assume we have this scenario here. An example of how these bond issue costs would be amortized is under the straight line method. So you amortize the bonds over the straight line method from the issue date, okay, to the date the bonds mature. Now, it just so happens here, all right, it says these bond issue costs were amortized under the straight line method. All right. And the costs are $2,000. All right. At January 1st, 20x0. Now, that is the date the bonds were actually, that's the date of the bond contract. The bond contract is dated. Okay. Has a date. Now, do bonds, corporations always issue bonds on the date of the contract? Yes or no? Usually the date of the bond contract is the date they announce that they're going to issue bonds.
Mhm.
All right. Now, do you think they're going to sell the bonds all on the date they announce it?
No.
Let's assume that, all right, on the date they actually, all right, announced the bonds, there was 60 months, all right, until maturity. But, all right, you, the corporation, sold the bonds, all right, 5 months after the bond date. All right, got that? 5 months after the bond date. And that 5 months after the bond date, which is 55 months to maturity, is called the issue date. Okay? All right. So the issue date is the date you actually bought the bonds on. All right. The date of the contract is the date. Isn't a bond contract a promissory note? Yes or no? Isn't it? You're giving me money and I'm promising to pay you back those proceeds at maturity. All right. Now, like any other contract, it has a date of the contract and it also has a date the bonds mature. We have to pay that money back. However, a lot of times bonds are announced that they're available for sale, but the bond holder, all right, the person who buys the bonds, they generally buy them maybe 5 months after the issue date. All right. I didn't say it right. 5 months after the date of the contract.
Okay.
All right. So therefore, normally, if they sold the bonds on the date of the bond, all right, they would amortize the bond issue cost over 60 months. You see that?
Yes.
If that's what the number of months until maturity, it'd be 60 months. But let's assume they didn't issue the bonds until 5 months after the date of the bond contract. All right. How many months would they amortize the bond issue costs over? All right. Let me repeat this.
Okay.
Less.
Right. The date of the bond contract to the date of maturity, all right, is a 5-year bond or 60 months. Okay. All right. Now, they didn't issue the bonds until 5 months after the date of the bond contract. Okay. So therefore, the bonds are going to mature in how many months?
60 months.
Minus the number of months between the what? The date of the bond contract and the date they issued it. You see that?
Yes.
Right?
Yes.
All right. So they're going to actually have what? 55 months that they'll amortize those issue costs over.
Okay.
All right.
Yes.
All right. Now, let's assume we have that scenario and it's 55 months. And let's assume also, I'm just going to take some figures. All right. It says here, let's assume that the issue costs are $2,000 and that's for a, how many year? They say a 10-year, let's make it a 5-year bond. Okay. All right. Or 60 months. Now, if they issue the bonds 5 months after, all right, they're not going to amortize the 2,000 over 60 months. They're going to take the 2,000 and amortize it over what? 55 months. Okay.
Yes.
They only amortize it, all right, for the number of months from the date of the bond contract to the date they actually have to going to pay it off. But they don't always sell the bonds on the date of the bond contract. They may sell it 5 months after that. All right.
Okay.
This is the point of going over this. All right. And it's because of the next topic. But if it's only 55 months till maturity, what they'll do is they'll take the bond issue cost and amortize them over 55 months straight line. All right. And when they do that, what they're going to do is this. All right. First of all, they paid $2,000 here on 1/1/20X0 of 2,000. Debit unamortized bond issue expense, credit cash. Now, the journal entry, all right, for the first interest date and also the first period they actually amortize the bond issue expense, all right, they're going to do what? All right, they're going to take the bond issue expense, $200, and credit unamortized bond issue expense, $200. All right, now, I wish I had an example of what I'm trying to tell you about, but it's not one in the back. I got to find an example of that one. All right. It's unfortunately not there, but this is what you have to know. All right. Bonds issued between payment dates. Bonds may be issued between interest payment dates and the date the bond contract was dated. All right. Now let's look at this example here. All right. Assume the firm sells $100,000 bonds dated August 1st, 20X4 at a par value on September 1st, 20X4. They pay interest 12% per year, semi-annually on April 1st and October 1st, all right? The journal entry to record the sale and the first accrued interest payment is given. Now, when did they sell the bonds? On what date?
August 1st.
That's not what I
August.
read. What?
August 1st.
No. Assume the bonds were sold 100,000. The date of the bonds is August 1st,
Oh,
but
September
they sold
1st.
it September 1st,
September,
right?
right, right.
All right. So
Mhm.
they're basically going to receive, all right, this, all right. They'll debit cash for 100,000 on September 1st,
Mhm.
all right, and they'll credit bonds payable of 100,000. All right. There's no discount of premium because they were sold at par value. All right. But on September 1st, all right, when I sell you bonds, what's going to happen? At the end of 6 months from the date of the contract, I'm going to pay you 6 months interest.
Mhm.
But if you bought the bonds 1 month after the date of the bond contract, what are you going to do? All right. You're only entitled to how many months of interest?
5 months.
5 months. Do you see that?
Mhm.
All right.
Mhm.
Now, the first interest period, a half a year semi-annually, is from August 1st, 20X4 to what date? October 1st, right? How many months is that? How many months is it from August 1st, 20X4 to October 1st, 20X4? How many months is that?
4 months.
2.
All right.
4 months. Mhm.
August 1st, you're telling me it's, wait a minute, let's
1
start
month.
again here. All right.
1 month.
1 month, right? All right.
Yes.
Now, remember, all right, on October 1st, whoever holds those bonds is going to get 6 months of interest. Do you
Mhm.
agree?
Mhm.
Right?
Mhm.
Because the interest is going to go from what? August 1st
Mhm.
to October 1st. How many months is that? August, September. All right. Let me
Right.
see it.
2
All right.
months.
They're going to get 6,000
Yes.
for 6 months. What am I doing wrong here? August 1st to October 1st is August, September, October. That's only 3 months, isn't it? Am I getting 3 months on that?
2 months,
2 months.
the month of August and the month of September.
Okay. I think my dates are wrong here. All right. Now, what's going to happen also is this. On the date they sold the bonds, all right, the
Mhm.
corporations will receive back the interest that the
Mhm.
bondholder will not be entitled to when they get the 6 months interest. And we agree, all right? The
Mhm.
bondholder is not entitled to the interest from what? August 1st to
Mhm.
September 1st, right?
Mhm.
All right. So what's going to happen is the bondholder is going to pay that 1 month interest back to the corporation. All right. And that comes out to how much?
Is it 1,000? What is it?
I think these dates are wrong.
Okay.
Oh, gee, God. All right. Let me check this. I'm not sure these dates are right. Because if they pay interest semi-annually on
Mhm.
April 1st,
Mhm.
all right,
Mhm.
it should be, the next payment date should be October 1st. Do you agree? All right. So it'd be for 6 months ending October 1st. All
Mhm.
right. What is 6 months till October 1st? When did that begin? We have 91X4. All right. There's a debit to cash 101, credit bonds payable 100, and there's the $1,000 of interest that the corporation is being reimbursed for. Why? Because at the end of 6 months,
Mhm.
the bondholder is going to get what? $6,000. All right.
Mhm.
All right. The date of the bond contract is not August 1st. I don't know what it is now. Let me check this. This is not right. Okay. I apologize. It's not right. Okay.
Mhm.
It might
But
be April 1st.
it probably is April 1st. Thank you. All right. So it's April 1st,
Mhm.
right?
Mhm.
And October 1st. So if it's April 1st, would that be, yes, that would be the next date, right?
Mhm.
All right. From August 1st
Mhm.
to X4 to April 1st of X4 is how many months?
X5.
August, September, October, November, December. No, it's still not right. All right.
Yeah.
Let me check that and find out what's wrong. All right, but this is what they ask on these questions of bonds issued between interstates. They want to know what the cash proceeds that the corporation will receive on the date they actually sell the bonds. Well, the answer to it is 101,000. However, I do have an actual question from the exam, which I know the dates are correct. All right, so let's look at that question. All right, now the question is, I think it's 173. Let's go to 173. God, why am I missing everything tonight? All right, default interest. All right, question 173 on page MCQ 231. Okay, all right. Let's look at FAR 2 Q173. All right, now on April 1st, 20X5, Gerard issued at 98% plus accrued interest, $201,000 bonds. The bonds were dated January 1st, X5. They mature in 10 years on January 1st. Interest is payable semi-annually on January 1st and July 1st, right?
Mhm.
All right, now, what was the date of the bond contract?
Mm,
January 1st, what?
2005, 2000X5.
X5, right?
Yes.
Now, when did Gerard sell the bonds? On what date?
April to X5.
April 1 of X5. Do you agree? All right.
Mhm.
So that when they pay the interest on July 1st of X5, they're going to pay for 6 months interest, right? They're going to pay from January 1st X5
Mhm.
to 7/1 X5. Corporations don't keep track of every bondholder who buys bonds. If they don't buy them on the date of the contract, they're not going to keep track of it. All they're going to do is at the end of 6 months, they're going to pay the interest to anybody who holds those bonds. So when does the corporation settle up with these bondholders? At the date they issue the bonds to them. And on that date, all right, the bondholders are going to reimburse the corporation for the interest they're not entitled to. Well, if the date of the contract was, what did we say? What date? January 1st, X5, right?
Yeah.
All right. If we didn't issue the bonds until April 1st, then, all right, the bondholders held it from April 1st, X5, all right, to 7/1 X5, right?
Mhm.
All right. So how many months of interest are they entitled to?
That's 6 months.
3
Yeah.
months.
3 months. All right. The bonds were issued April 1st.
Mhm.
All right. They pay the first interest payment July 1st. So they only held it for what? 3 months of the 6-month period. So the bondholders are only entitled to 3 months. Okay.
Mhm.
All right. Let me go. Sonny, take it to the board a second. Okay. All right. Let me put this up here. All right. All right. You have the question. So, all right. What's going to happen is this. The date of the bond contract is what date? 1/1 what?
2X5.
All right.
2X5.
X5. Okay. All right. And that's the what? Is that the date of the bond contract? Yes. Date of contract.
Mhm.
Now, all right. They issued the bonds to the bondholders on what date?
April 1st.
April 1st.
Mhm. 2X5.
X5. All right. So therefore, from January 1st, X5 to April 1st, X5, which is 3 months,
Mhm.
when the corporation actually pays the 6 months of interest, how much is the person who buys the bonds have to pay back the bondholders on the date of the sale? How many months?
I think it's 3 months.
3 months,
Mhm.
because they're going to pay interest on what date? 7/1.
7/1, right.
All right. So the bondholders own the bonds from April 1st until July 1st. So the bondholders are only entitled to 3 months of interest. That's what they're entitled to.
Mhm.
All right. Now, at the date of the bond interest, they're going to receive the bondholders 6 months of interest.
Mhm.
All right. But they're only entitled to 3 months.
Mhm.
So what are they going to have to do? at the date that the bonds are sold to the bondholder, all right, the bondholders are going to give back how many months of interest?
3 months.
3 months. Okay.
Mhm.
All right. Now let's make the journal entry for that. Can't put the word 3 here. All right. Now, one entry will they make on the date they sold the bonds? Now, they sold the bonds on what date?
Bonds are
April 1st.
April 1st. That's the date of the sale, right?
Yes.
All right. Now, on that date, how much is the corporation getting? They're selling the bonds at 98%. All right. That would be how much? 98% of the bonds gives you what? All right. First of all, you're going to credit bonds payable for how much? We have $201,000 bonds, right? So we're
Yes.
going to credit bonds
Yes, right.
payable for what? 200,000? Do you agree?
Mm-hmm.
All right. Now, but we're selling them at 98%. All right. So therefore, the corporation's going to get how much in cash?
196.
All right. They're going to get 200,000 times 98%, right? All right. What's 98% of 200,000?
196,000.
198. Isn't that 198? Yes or no?
196.
196. Okay. All right.
196, yes.
All right. So this is 196. All right. Now, what's the journal entry we're going to make on the books, the corporation? All right. First of all right, what we're going to do is we're going to credit bonds payable for 200,000. All right. Now, how much interest is going to be reimbursed? How much interest is going to be given back or received by the corporation that they're not entitled to? All right. Now, I have here that they're entitled to 3 months, all right, of interest. All right. But they're entitled to get back how much? All right. 3 of the 6 months, right? All right. Now, what's the interest on the bonds? The interest on the bonds is what? 200,000 times 5%, which is $10,000, correct? All right. Now, the person who got the interest for 6 months has to give back what? 3 of the 6 months. Do you agree?
Yes.
All right. So 3/6 of this is what? 5,000. So therefore, all right, what's going to happen is, all right, the bond corporation will credit interest expense for how much? They're going to reduce their interest expense by 3 out of 6 months. Do you agree? Yes or no? All right.
Yes.
That is what? 5,000? All right. So my entry shows a credit to bonds payable of 200,000. All right. Now I have 200,000. All right. I have a credit to interest expense of 5,000. All right. Now we issued the bonds at what? 98%. All right. Is there a discount on the bonds? Yes or no?
Yes.
Yes.
All right.
Yes.
98% of bonds payable, all right, is what? 2% is the discount, right? All right. 2% of 200,000 is what? $4,000. All right. So we'll have a debit to bond discount for $4,000. All right. Now, what's going to be the proceeds of the bonds to the corporation? How much will it be? All right. It's a debit to bond discount of 4,000. Bonds payable is 200. They credit interest expense. All right. I get a debit to cash of $201,000. All right. Now, what's the question asking for? All right. The question's asking how much would they receive in net cash receipts, all right, from the bond issuance? All right. What would they receive the corporation? How much?
1 minus, let's see,
What do you think the answer is?
101,000.
Plug the entry I showed you. What is it? $201,000. That's the cash receipts. Okay.
Okay.
All right. and these dates were correct. All right, so how do you handle this when bonds are not sold on the date of the bond contract? They're sold afterwards. What you do is, all right, if it's 6 months of interest, they were dated 1/1x5, but they were not sold to the issue date of 4/1x5. So they were sold 3 months after the contract, right? But when the first interest payment is made, which is 6 months after, 1/1x5, the 7/1x5, all right, they're going to pay the bondholders for 6 months of interest, right? Now, how many months of interest are the bondholders entitled to?
3 months.
3 months, all right? So the bondholders are going to receive what? 6 months of interest, which is how much? What's 6 months of interest? It's 5% of 200 is $5,000, right? All right. Now, they're going to have to give back how many months?
3 months.
3 months. So how much are they going to give back? How much are they give?
Back
They're going to give back how much?
2,500. Is it?
5% of 10,000, right? Are we doing this right? All right. We have here, all right, 10% bonds. The 10% bonds. All right. So it's 10% of 200,000. All right. Annual interest is 10,000 or 20,000, right? Am I right on that? All right. So therefore, all right, they have to give back. What am I doing wrong here with these dates? It is 200,000. All right. Times 10%, right? 210%. So every 6 months it's 5%, right? All right. So therefore, all right, when they pay the first 5% of the 200,000, all right, which is how much for the 6 months? 10,000.
10,000.
All right. They're going to record. They're going to receive interest income theoretically of 10,000, but they have to pay back what? 3 of these 6 months, right? They have to pay back 3/6 of the 10,000. All right. So therefore, what is the corporation going to get at the date of issuance? They're going to get the cash proceeds from the bond, which is how much? All right. It's 98% of 200,000, right? Plus the interest of 5,000. What's 98% of 200,000?
0.9.
196, right?
196.
And also, all right, the bondholder is going to give them back 6 months of interest, which is what? $5,000. All right. So therefore, the cash proceeds the corporation will get is 201,000. All right. Now, when the corporation books this, as far as interest expense goes, all right, what's going to happen is, all right, at 7/1 of X5, all right, if we look at the interest expense account, all right, the interest expense will be how much for that period? $10,000, right? Right?
Yes.
But when we sell the bonds, all right, on 4/1, all right, we're crediting interest expense for what? 5,000. So the balance of the interest expense is how much? $5,000, which is what? Half of 6 months. Am I correct?
Yes.
All right. You see that? Has anybody ever seen this before? Selling bonds between interest dates?
Yeah.
No? Is this a new concept?
Not really.
All right. If you know what, I'm going to find some more questions on this, but this happens to be actually a popular question. You want to know why? Because people don't understand. A bond is a contract. It's dated, okay? All right. And it's dated from the date the contract is signed or entered into. No, not entered in. It's signed on the date they write up the contract. Now, they don't always sell the bonds on the date of the bond contract. Why? Because by the time they announce it, they may not sell it till like 3 months after that date. So what happens is the settlement of how much the bondholders have to reimburse the corporation for the interest they're not entitled to is done what? The date the bonds are issued to the bondholder.
Okay.
Okay?
Okay.
All right. Do me a favor. Try to work that question 173. All right? that probably is one of the most difficult concepts in this chapter. But you got to look at it. You got to look at it. All right, now the rest of it should be a little easier. All right, because I want to go to, oh, this will be a lot easier. All right, let's go to page 2H27. All right, we did this. And then on the bottom, 2H27, bonds with detachable warrants. Okay.
Mm-hmm.
I thought I corrected this entry for the, let me see, bonds with interest dates. 2H27. Hold on one second. Let me just see what's in my book here. 2H27. Okay. 2H27. And I have a debit to cash 101.91. Then on April 1st, X5, this entry is wrong. Something's wrong here. All right. I will get you the correct entry. Okay. All right, here we go. Now, this is always a question on bonds. And what it is on page 2H28. All right, 2H28. All right. And it says bonds with detachable warrants where both the fair market value of the bonds and the warrants are known. Now, when I issue bonds with detachable warrants, all right, you have the bonds and you have detachable warrants. That means that the person who actually owns the bonds can sell the bonds and sell the warrants separately, or they can just sell the warrants if they're detachable from the bonds and the warrants. Now, when they sell bonds with detachable warrants, remember, the proceeds from the sale of the bonds and the warrants have to be prorated, all right, between the bonds and the warrants based on their relative fair market values. So if you know the fair market values of both, you'll do a proration of the fair market values times the proceeds, and that's how you determine how much goes to the warrants and the bonds. All right, now let me start with this. All right, we're on page 2H28. All right, now let's assume that on 1/2X1, Megan issued 2,000 5-year $1,000 bonds with detachable stock warrants at par. Each bond has a detachable warrant for 1 share of Megan's common stock at a specified option price of $35. Upon the issuance of the bonds and the warrants, the fair market value of the bonds alone was $1,000,001, and the fair market value of the warrants were $150. All right. Don't we do a lot of proration accounting based on relative fair market values? We do that. All right. So, all right, we sold the bonds. How much proceeds did we get from selling the bonds?
2 million.
2 million. Good. All right. Now we're going to take those $2 million. All right. And we're going to prorate it between the bonds and the warrants based on the relative fair market value. How much is the fair market value of the bonds by themselves? Right there. It's how much?
1,100,000.
1,000,001, right? Is that what it said? Told us that. All right. What's the fair market value of the warrants?
150,000.
150,000. All right. So the fair market value of the bonds is 88% of the proceeds. And then the fair market value of the warrants is 12% of the proceeds. So what we do is in step 3, all right, we take the proceeds of 2 million and we multiply it by 88%. And that's how much of the proceeds will go to the bonds, 1,760,000, and 12% of the proceeds will go to the warrants. Now, what you do is you're going to prepare a journal entry for the issuance of the bonds with detachable warrants. Now, let me tell you this. When you set up the portion of the proceeds that goes to the detachable warrants, you credit paid in capital stock warrants. All right. What type of an account is that?
Paid in capital.
Paid in capital, right? All right. Where does that go? What financial statement?
Balance sheet.
Balance sheet in the paid in capital section, right?
Yeah.
All right. Do we have different paid in capital accounts?
Yes.
Yes.
We have paid in capital from treasury stock, right?
Mhm.
We have paid in capital excess of par when we sell common stock. We have paid in capital excess of par when we sell preferred stock.
Mhm.
All right. If we donate property to our corporation, we debit the fair market value of the property and credit paid in capital donated assets. That's a paid in capital account. Okay.
Mhm.
All right. Now, when you sell treasury stock at a gain, what does the gain on treasury stock go to? Anybody know?
You don't have a treasury stock on gain, do you?
Well, yeah, but
Oh.
does it go to income statement? Where does it go? It goes to paid in capital. All right.
Treasury stock.
Treasury stock transactions, right?
Yes.
And if you have a loss on treasury stock, it goes to where normally? All right. First, you use up any paid in capital from treasury stock that you have left. Use that up by debiting it. And then any balance goes to a debit to retained earnings. Remember, there's no gain or loss on treasury stock going through the income statement. Okay.
That's
All right.
right.
So we determined the paid in capital stock warrants were 240,000. All right. And we determined that, all right, how much of that went to the bonds? 1,760,000. All right. Now, how do you do that? The carrying value of the bonds is 1,760,000, right?
Mhm.
All right. So how much of the bonds payable going to be credited for? What's the bonds payable going to be credited for?
2
2
million?
million.
2 million. All right. What's the carrying value of the bonds? 1,760,000, right? So we're going to have a plug to unamortized discount on bonds, 240,000. You see that?
Yes.
Mhm.
All right. So usually on these problems, when they give you the fair market value of both, do the proration, but credit paid in capital stock warrants for the fair market value of the proceeds that goes to the warrants. The balance normally of the proceeds would go to the bonds. But what you do is you set up bonds payable at the face value, and you subtract the discount or add a premium to come up with the amount of the proceeds that goes to the bonds. All right. Do you understand that? Yes or no? All right.
Yes. Mhm.
Good. All right. Now, what happens if you have bonds? The next thing with detachable warrants, where only one fair market value is known. What happens if you only know the fair market value of the warrants? Okay.
Mhm.
All right. Now it says here that assume the same facts, except that only the fair market value of the warrants are given, and the amount is 150. All right. Now, what's our entry? How much cash are we getting for selling the bonds and the warrants?
2 million.
2 million. W cash 2 million, right?
Yes.
All right. What are we going to credit stock warrants for? Paid in capital.
150,000,
150, which is what value?
which is the warrant.
At what value?
At let's see.
The fair value.
FV, fair market value, right?
Okay. Yes.
All right. So the cash proceeds are 2 million.
Mhm.
150 goes to the warrants. Then the
Mhm.
balance of the proceeds are going to go to the what?
To the bonds payable.
To the bonds, right?
Mhm.
All right. Now, what's the balance of the proceeds that goes to the bonds? How much? It would be a million. What is it? 150,000 goes to what? The paid in capital. All right. And 2 million is the cash. So we got 1,850,000 going to the bonds, right?
Yes.
1 million. All right. So $1,850,000 has to be the carrying value of the bonds.
Okay.
All right. Now, how do you get the 1,850,000? The bonds payable are how much?
2 million.
2 million. So we'll credit bonds payable 2 million, right?
Mhm.
All right. Now, what are we going to debit? Discount or premium?
Discount.
Discount. All right. So we will debit unamortized discount for how much?
150.
150,000.
Mhm.
All right.
Mhm.
Is that the entry there? Yes or no? Okay.
Mhm.
All right. That's not
So
hard.
how do you determine it's a discount in the bonds payable at par is 2 million?
Because, all right, when you only know the fair market value, and generally only the warrants, all right, you take the proceeds, subtract the fair market value of the warrants, which goes to a paid in capital account, right? All right. The difference between the proceeds you get, the 2 million, less the fair market value of the warrants, 150, which means that 1,850,000 has to be the proceeds that goes to the bonds, right?
Okay.
Now, you're going to back into the discount or premium. You know the bonds payable has to be recorded what amount?
Face value.
Which is what, 2 million?
Yes.
Mhm.
All right. And you know the balance of the proceeds, which is 1,850,000, all right, has to go to the what? The carrying value of the bonds, right?
Okay.
Yes.
All right. So how do you get from 2 million bonds payable to a
Mhm.
carrying value of 1,850,000 to the
Mhm.
bonds? You have a what? A debit to
Discount.
discount on bonds. It's a plug.
Oh, it's
Okay.
a plug.
Could you have a premium on the bonds?
Yes.
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 Mhm.
Okay.
That is right.
All right. Now,
Thank you.
all right. You're
How would
very
that
welcome.
work? How would a premium work with a stock warrant?
How would the, well, if the warrants, well, I'll tell you how it would be. Let me see here. The warrants would have to be, let's say, some warrants of 50,000, all right? And now it, you have to create some numbers, but there still could be a premium on bonds, okay? If the total proceeds and you subtract the warrants, all right, that would give you a carrying value of the bonds in excess of the face value. All right. It's
Mhm.
just the 150 is a plug. All right. Now, just to review, I want you to go to, all right, one thing here. It's on page 2H31. 2H31. All right. Now, it says this, 2H31. Perform debt covenant calculations as stipulated a debt agreement to ascertain compliance. Okay.
Mhm.
All right. Now, a debt covenant is an agreement between a debtor and a financial institution. There are 3 types of debt covenants. Read these. Affirmative positive covenants require the debtor meet certain requirements, all right, providing financial statements to the financial institution or carry liability insurance on the debt. Or you can have a negative covenant, which prohibits the debtor from incurring additional loans without the approval of the lender, and the debtor is restricted from selling assets the debtor owns without the financial institution approval. And financial covenants require the debtor must produce ratios showing liquidity or performance that match a specific standard. For example, a company must be able to show they have a positive net worth. Okay?
Mhm.
All right? Now, if the debtor doesn't meet the requirements of the agreement between the debtor and financial institution, the bank may be able to call in the loan, all right, prevent any additional lending, exercise the right to seize the collateral on the loan, and as a last resort, bring a lawsuit against the debtor. All right, this is nasty, isn't it? All right, now, there are many financial ratios used in debt covenants. They include ratios that are affected by earnings, all right? Ratios based on earnings before interest and taxes. You see that? And depreciation and amortization. Debt to equity. Nevertheless, to decrease the borrower's incentive to manage earnings, the lender can specify in the debt agreement that the debt covenants must be measured using GAAP compliant financial statements. All right. Now, what is a ratio I might want to look for if I'm a bank? All right. And I want to make sure that they're probably going to pay interest if I lend them money. And I look at other loans they have. Now, one ratio is called times interest earned. All right.
Mhm.
You ever heard of that one?
Yes.
Now, does anybody know the ratio times interest earned? All right. Anybody know what it is? What's the numerator? Don't cheat. You're not going to go to the, all right. All right. On the exam, they won't let you go to Google or something. You aware of that? All right. Now, all right. So what's the ratio? Do you know times interest earned? All right. It's interest expense
Mhm.
divided by, all right, the net income of the company before interest
And taxes.
and before taxes.
Mhm.
So, all right, what they're saying is this. They want to make sure that you have enough net income, all right, before you take out any additional interest for other loans, or before you subtract out taxes, all right? Now, this will tell me if we have enough interest, all right, I think it's net income, I'm sorry, I did that wrong. It's net income before interest and taxes, all right, divided by interest expense. I did the opposite. Okay, all right, now the numerator is net income for interest and taxes divided by the interest expense you pay on all loans. Now, what this is going to tell me is this: I have enough net income from our business, all right, to pay off all the interest expense we may occur. Do you see that?
Mhm.
So if this ratio is 8 to 1,
It's frozen.
Hopefully it'll unfreeze here in a minute.
Mhm.
your present interest expense, what is it? What's the matter?
You were frozen for a minute.
Okay, all right. So this is a ratio they do ask, all right, and it is, all right. It's net income before interest and taxes divided by interest expense, all right. Do I have enough earnings to cover my present interest? Okay,
Okay.
all right. What is some other liquidity ratios?
Working capital,
All right, working capital, right. What is working capital?
CA minus CL. Current assets minus current
Oh, I didn't
liabilities.
say you say C. Okay, so it's current assets minus current liabilities, right? Which
Yes.
gives you net current assets. All right. Now, is that at a good measure of liquidity? Is that an immediate measure of liquidity?
No.
No, because your current assets could be inventory,
Mhm.
right?
Mhm.
They could be what? What else? Prepaid insurance.
Mhm.
All right. I can have a tremendous net current asset by having non-liquid assets.
Mhm.
All right. So the more immediate measure of liquidity that you might want to use is called the what? The quick ratio, right?
Yeah.
All right. And what's the quick ratio?
That's cash, marketable securities, and
Net accounts receivable.
thank you.
No, I'm sorry. All right. All right. Divided by current liabilities, right?
Yeah.
So that's those are more immediate sources of assets that can be converted into cash, right? Cash is about as immediate as you're going to get. All right. Then you have marketable securities and also net accounts receivable. Now, when you're looking at those net accounts receivable, you want to look at an aging schedule. All right. Because you don't want to add net accounts receivable that are more than 120 days old. All right. You want to find receivables that are generally what? You know, probably less than 30 days old. Okay. Would you agree?
Yeah.
All right.
Mhm.
And I'm trying to think of another, any
Ratio?
other liquidity ratios you can think of?
Mm.
All right. Now, quick review. All right. Are you ready? I'm going to ask you questions about bonds. All right. When you issue bonds, you can issue them at a discount or premium, right?
Mhm.
Right.
All right. Now, let's assume you issue them at a premium, all right?
Mhm.
And you have a yield rate on the bonds.
Mhm.
The yield rate
Mhm.
is 8%,
Mhm.
and the bond rate
Mhm.
is 6%. Let me
Mhm.
erase this board. Okay, hold on one second. All right, now,
Look at you, huh? You don't use the eraser no more?
who, Sonny? You know, you have to do everything. You kidding me? I have to. And if this thing is not, this you can't get this always clean unless you use, get this, the board was made by Expo. Who do you think issues the cleaning? Expo. All right. All right. So anyway, all right. So we said the yield rate was what? What was the number I gave you?
8%.
8%.
8% yield, also known as the what?
Market rate.
Market. All right. And also we have the stated or coupon rate of 6%.
Mhm.
All right. Based on this, Is the bonds going to be issued at a discount or premium by the corporation?
Discount.
Discount, correct. Now, how do you calculate the proceeds from the sale of the bonds? What do you take?
Present value
Present value of what?
of $1.
Of $1, all right? And you multiply that by that factor for the present value of the face amount of the bonds, right?
Right.
Now, when you go to a present value of $1 table, all right, what are you going to use for the interest rate?
The yield rate.
The yield rate, but only for the number of months you actually pay interest for that period. So if it's semi-annually, it'll be what? 6 months, right? Do you
Yeah.
agree?
Right.
All right. Now, the next thing is, remember, all right, your interest payment is based on the what? The stated rate, if it's semi-annually, for 6 months, all right, times what?
Face value.
Face value, all right? And what present value table is that?
$1.
If you make,
$1.
no. Present value of an annuity.
Annuity, yeah.
Oh, interest, right.
What's the definition of an annuity?
Series of payments.
Series of same equal payments, right?
Yes.
All right. So you can take the interest payment you make times the present value of an annuity. Now, if you make the first interest payment at the end of the first year, that's an what? Ordinary annuity, right? All right. So you go to the present value of an ordinary annuity. All right. You look at the interest rate, right? The yield rate for 6 months times what? How many periods do you use?
Month.
You take the number of periods they're going to pay interest, right? All right. So if it's a 30-year bond, all right, and they pay it semi-annually, we're looking at 60 months of interest, right?
Right.
All right. Now that equals the total proceeds. All right. Now, what entry do you make when you issue bonds at a discount? All right. You credit bonds payable at what amount?
Face value.
Face amount, right? All right. If it's sold for less than face value, what do you have there?
A discount.
Discount. Do you debit or credit bond discount?
You debit bond discount.
Debit bond discount, right? And the difference should be a debit to what?
Cash.
Cash.
No,
Good.
no.
All right. Now, if you have a bond discount that you're amortizing, you're going to amortize it when? Every time you pay interest or, all right, remember, you have to accrue interest at the end of the year, don't you? All right.
Right.
If the bonds are issued on January 1st, all right, then don't forget, at the end of the first year, you have to accrue the interest expense, right? Now, when you accrue the interest expense, do you also have to amortize the discount or premium on that date?
Yes, huh?
Yes. Don't forget that, all right? When you accrue the interest on bonds at the end of the year, don't forget you also have to write off the bond discount or premium. Now, how do you amortize bond discount or premium? You set up an amortization table, right?
Right.
Tell me the columns.
Interest payment.
Interest payment, what's the second column?
Interest
This
expense.
expense.
Interest expense, what's the third column?
Discount.
This kind of
The amortization amount. And then the last one is the carrying value, right?
Oh, I
Right.
know.
Let's assume my carrying value is issued at a discount, okay?
Mhm.
We have $1 million bonds issued at 850. So we have an unamortized discount of 150, okay? All right, now, how do you get the column interest payment? What do you do?
Interest payment.
Just take the stated value times the
Not stated value,
Correct.
stated what?
stated,
You
The
take
rate.
stated interest
Stated
rate.
rate, right? If it's semi-annually, 6 months, right? All right, and then you multiply that by the what?
Period.
Get the, what?
The face
Face
amount.
amount of the bonds, good. All right, how do you get the interest expense?
Interest expense. Well,
You take the yield rate.
You take the what value first?
present value of annuity.
Carrying
No,
value
the carrying value,
The carrying
right?
value.
times
Which is the
yield.
bonds payable less the discount or
Okay.
plus the premium, and you multiply that by what rate?
yield.
Yield
The
rate.
yield rate for 6 months, if that's what it is, all
Right.
right? And don't forget that when you actually originally issue the bonds, don't forget, you look at the yield rate, semi-annually or whatever, and also don't forget, you actually use for the number of periods, the number of periods you're gonna pay interest over, okay? Did that just confuse you? All right, now, the difference between the interest payment amount
Mhm.
and the interest expense is the what?
Amortization.
Amortization.
Amortization of the discounted premium, right?
Mhm.
Mhm.
All right, if you have an amortization of discount, what do you do to the carrying value?
You add it to the current value.
Add it. And if you have amortization premium, you what?
Subtract.
Subtract it.
Subtract it. Now, if I buy bonds, all right, you issue the bonds, all right, let's assume you receive, all right, $200,000, all right, and the face amount of the bonds are 200,000. I'm going to plug in a different number here in a second. All right. And I have a discount, bond discount here of 20,000. All right. Now my cash will be what? 180, right?
Mhm.
Now, this is to the corporation issuing the bonds. Now, the investor has to make an entry, don't they?
Right.
All right. So the corporation, all right, debited bond discount 20,000, debited cash 180, and credit bonds payable 200,000. All right. What entry will the investor make? What entry?
Debit bonds payable.
Investment in bonds.
If
No.
I want to invest in bonds, I'm going to pay. I'm going to credit bonds
interest
payable.
receivable. Interest receivable.
No, you
Investment
debit.
in
What's the
bonds.
opposite of bonds payable? Not bonds receivable. Okay. It's investment in bonds. You get that?
Okay.
All
Okay.
right. You'll debit investment in bonds.
Mhm.
All right. Which in this case would be what? 200,000, right?
Mhm.
200,000.
Right.
All right.
Mhm.
And you would do this. You would credit bond discount for how much? 20,000.
Yes. 20,000.
And then I would credit cash for what?
180.
180,000, right?
Yes.
Now, what does the amortization schedule look like for the amortization of the bond discount to the investor? All right. Let's talk about the amortization schedule. All right. Let's get the columns. All right. We know the corporation, the first column is the interest payment, right?
Yes.
So what's the opposite of that to the investor?
Interest receivable.
Receivable.
Interest received, right? Interest received. All right. The second column is interest expense to the corporation. So what is it to the investor?
Interest income.
Interest income, correct. And the difference between the interest income and the interest received is the what? The amortization amount, right?
Right.
All right. Now, in this case, the bonds were issued at a what? Discount. Now, some textbooks will show investment in bonds 180,000, or they'll show the bonds at face amount, the investment, and they'll set up a discount, which is a contra account to this investment. You see that? So therefore, you'd have an investment in bonds on your balance sheet less the unamortized discount. Now, the question is this. If I buy bonds, I bought them here at a what? A discount, correct? All right. And it's 20,000. And the difference between my interest received and my interest income, all right, in this case, the bonds were issued at a what? Discount. Is that correct? All right. So I paid how much for this bond? 180,000, right? Why did I pay 180,000 where maturity, I'm going to get 200,000, right? Right? Why did I pay less? Because I must be getting a higher rate than the market, right?
Right.
Is that correct?
That's correct.
All right. So what I will do is I'll take the difference between the interest received and the interest income. All right. And that would be the amortization here of the discount. Now, I would have here a column unamortized bond discount, and it was what? 20,000. So therefore, what I'm going to do is this. I'll take the interest received minus the interest income, all right? And that gives me the difference is the amortization of the discount, correct? Now, what am I going to do? The difference between two is the amortization of the discount. All right. What am I do with the amortization discount? In this case, where the discount is 20,000. Am I going to decrease it when I amortize it or increase it? Does anybody know what I'm talking about?
Decrease.
We're going to decrease it, right? because of maturity, all right, what happens? Our bond discount will be totally amortized, won't it?
Mhm,
Right?
mhm.
All right. And remember, if the bond discount is totally down to zero, then my investment in bond will be what? $200,000, because when I turn the bond in, I will debit cash, 200,000, credit investment in bonds, 200,000. Okay. All right. Now, that's another chapter, actually, investment in bonds. But make sure you know an amortization table from the standpoint of the bond company issuing the bonds, and also, all right, the investment in the bonds. Okay.
Mhm.
All right. Now, all right. So you went over the amortization table. I think you got that pretty well, right?
Mhm.
And all right, we know to amortize discounted premium from the corporation standpoint. All right. And what else? All right. First of all, presentation of debt issue costs. All right. If you have bond issue costs, all right, how do you show them on the balance sheet?
A separate line.
Are they a
separate-
deferred charge?
No,
Are they an
No.
asset account?
No.
no.
No, what are they now?
Expense.
They're a
That's
direct
expensive.
they're a direct deduction from the carrying value of the bonds.
Mhm.
All right.
Right.
So
Yeah.
in the liability section, you would have bonds payable.
Mhm.
All right. Let's assume unamortized discount. And if we have a deferred charge for the issuance costs, all right,
Mhm.
what we would do is we would actually do what? All right. We would amortize those bond issue costs, would we not?
Mhm.
Right.
All right. So we credit bond issuance costs. And what will we debit? Amortization of bond
Yeah, bond
issuance
discount.
costs. All right. Now, when you amortize bond issuance costs, all right, how do you show that? What is it? Amortization of bond issuance costs are shown as what on the financial statements? And the answer is they're interest expense, interest expense. All right. So when you amortize them, you credit bond issue costs, debit interest expense. All right.
Oh,
Yes.
so on the balance sheet, you always show the bond at the net carrying value, and to get that is the face value plus or minus the unamortized. Because once
Repeat that.
so when on the balance sheet of a bond, you always deduct the unamortized amount to get the carrying value of the bond itself.
You take, if you issue the bonds at a discount, you have a bonds payable less unamortized discount. That's the carrying value.
Okay, that I just
If
had to
it's-
say that in my
yeah,
head at the time.
If it's premium, you have bonds payable plus unamortized premium, right?
Okay.
Now,
And then real quick,
yes.
Phil, about the discount, I mean, not the discount, sorry, the cost that you're amortizing. Would you
Yes.
also subtract that from your bond payable amount?
Yes,
on the
that
balance
would be
sheet to have
the
some-
unamortized bond issue cost would be a reduction of bonds payable. That's correct.
Okay, thanks.
All right. Now, however, all right, that rule went into effect, I think, 2 or 3 years ago. So there are still some bonds. We have bond issue costs. And back then, bond issue costs was shown as other assets, a deferred charge. You got that? All right. Now, those old bond issue costs, which are being shown as a deferred charge, they're not part of the carrying value of the bonds. They still have to be amortized as bond issue cost expense. You see that? They are not interest expense. All right.
So, but when we do I'm just trying to think of when we do an asset to get a long-term asset at the and depreciate it, we use to get the net value, we consider the depreciated amount, the accumulated depreciation.
What are you talking about depreciation? On what?
On an asset. When we
Well,
have
no.
an asset, we
Well,
always
you talking about bond issue costs?
No. This is another question about depreciation. So when we have an asset, we all to get the carrying value, we have to take the accumulated depreciation amount. But when we have
no. When you, all right, let's assume you have, first of all, if you're using straight line depreciation, how do you depreciate it each year? You take the what?
The depreciable, I guess, base divided by the number of years.
You take the cost minus the salvage value, right? Straight line, you subtract the
cost.
salvage value, right?
Salvage value, right,
And that's the
correct.
amount you depreciate, that net amount. All right.
Correct.
Now, if you use double declining balance, all right,
No DDB. I mean, no salvage value.
no salvage value. It's basically twice the straight line, isn't it?
Correct.
All right. And sum of the year's digits is an accelerated method, right? Now, with
Correct.
sum of the year's digits, do you subtract the salvage value from the cost?
Yes. Huh?
Yes.
Okay.
And do you know the formula to get the denominator, the number
Yeah.
of periods?
Yes. I know.
What is it?
In parentheses, n+1 divided by 2.
Correct. All right. N times n+1 divided by 2 gives you the denominator for sum of the year's digits. Okay.
Okay.
All right. All right. Good. All right. Now we have a few minutes, and I know tomorrow, don't we have class again?
Sunday.
So, no. Well, we have the afternoon will be deferred income taxes. Okay. All right. Accounting for income taxes. All right. But let's see if you can tell me some things, because these are on the exam. Okay. All right. And they deal with what we call, all right, stockholders' equity. Okay. All right. Now, tell me, when you buy back treasury stock, all right, what's the two methods of buying it back?
Market method.
Market method.
No,
All right.
it's cost in I think it's cost in treasure.
Treasure stock. Yeah.
Par value. No.
Par value. Very good.
Oh.
Okay. All right. Now, when you use the cost method, all right, you'll buy them back at the cost. Debit treasury stock at cost, credit cash, whatever it is. Okay. Cost. All right. Now, if you let's assume this is $100,000 and you decide that, all right, you actually resell half of these bonds, not bonds, treasury stock back, half of them at a gain of 125. All right. You'll debit cash for 125. Did I say half? Credit treasury stock for 50,000. All right. And what will you credit? Gain on sale of treasury stock, right? You agree?
Yes.
No.
Well, I was going to treasure stock at excess of par.
All right. Paid in capital from treasury stock transactions. Okay.
Yes.
Now, is this the same paid in capital? All right. Is this the same paid in capital that
No.
when you issue stock, you have paid in capital excess of par? Is it the same account?
No.
No. This represents gains for the sale of treasury stock. You got that? All right. That's when you have paid in capital excess of par. All right. And remember, all right, if I sold the remaining treasury stock for, let's make it 30,000, I would debit cash 30,000, correct? All right. Now, I would treasury stock for 50,000. And what would I debit?
Paid in capital.
I would debit paid in capital, right?
Yes.
All right. All right. All right. So I would debit paid in capital. All right. You want to get rid of the paid in capital you recorded up to 75,000. So you'll debit paid in capital for treasury stock transactions up to 75,000. Well, here you have 20,000, right? All right. Now, what happens if you use up all the paid in capital from treasury stock? All right. And you need a debit, all right, as a loss on treasury stock. What do you debit?
Retained earnings.
Retained earnings. Very good. Okay. All right. Now, we can have dividends. Dividends are paid on preferred stock, right? All right. Now, if you look at page 2, I think it's Hijk, page 2I3. All right. Do you have 2I? All right. You're going the wrong way. Okay, here we go. All right. 2I, that's it. Beautiful. All right. Now, preferred stock. First of all, we can have 100,000 preferred stock
Mhm.
All right.
Mhm.
And the preferred stock is cumulative.
Mhm.
All right. Let's make it 500,000
Mhm.
of preferred stock.
Mhm.
They're cumulative and participating. Fully participating. Okay.
Mhm.
All right. Now, the dividend, the fixed rate on these are 6%.
Mhm.
Okay.
Mhm.
All right. Now, the common stock has a par value of $200,000. Now, if they paid, for example, $50,000 of dividends, I haven't come up with a number before, but let's say the dividends paid or declared are $50,000. How would you distribute this to the preferred stockholders? All right. First of all right, they're 6% cumulative and fully participating. All right. So what do? The preferred stockholders would get how much of the 50,000?
6%.
6% of what value?
50,000.
500,000. Right?
Yes.
Of the par value. That's 30,000? Is that 30? Yes or no?
Is it not 3,000?
6% of 500,000. Is that 3,000?
Oh, no. It's 30,000.
30,000.
30,000, right?
Right. Mhm.
All right. Now, the the common stockholders have a par value of 200,000. All right. So what's going to happen? You're going to pay them 6% of their par value. All right. That's what they get. 6% of their par value.
You wrote
Did
down,
I
it
say
should be 30,000, not
it'd be
300.
30,000? You're right. All right. 30,000. All right. Now they would get 6% of the 200,000, wouldn't they?
Yes.
Mhm.
All right, which is $12,000. Now, how much of dividends have we not paid out?
18,000.
I'd say 8,000, wouldn't you?
Yes.
8,000. All right. Now, how would you divide up the 8,000 between the preferred and the common? Now, the preferred are cumulative and fully participating. So therefore, the remaining dividends will be allocated to the preferred and the common based on the relative par value. Got that? All right. So we take the preferred stock. All right. The total par value is 500,000. The common stock have a par value of what?
200,000.
200.
Mhm.
So we add this together, we get $700,000, right?
Mhm.
All right. Now, 5/7 of 8,000, all right, would go to the preferred stockholders, wouldn't it? 5/7
Mhm.
of the 8,000. And then the common stock would get what? 2/7
Mhm.
of the 8,000. All right. So
Yes,
what would the preferred stockholders end up with? They would end up with the $30,000
Mhm.
plus what? 5/7 of 8,000. Do you see that?
Mhm.
All right. The common would get what? 12,000 plus 2/7 of 8,000. All right.
Mhm.
Is that enough? Is there enough money to cover that? Yeah, we're okay.
Yes.
All right. But you got to know common stockholders equity. It's very, very important. All right. Now, we just went over cash dividends, right? All right. I know you're getting tired. All right. By the way, if you haven't watched it on Amazon Prime, great show. It's called Affair. Did I tell you about that one? Okay. All right. It makes 60 Shades of Gray 200 Shades of Gray. Okay. All right. So anyway, all right, here we go. All right. Stock dividends. How many different types of stock dividends are there?
Common stock.
No. There's a large stock dividend and a small stock dividend, right?
Okay.
All right. Is that right?
Mhm.
And in the middle, it's what? A teeny weeny one. No. All right. Now, when you have a large stock dividend, it's normally where the stock dividend increases the outstanding shares by more than 20 to 25%. Remember that?
Mhm.
All right. So a large stock dividend increases the shares more than 20 to 25%. Now, in that case, when you have a large stock dividend, what do you debit retained earnings for?
The par value?
The number of shares you're giving them times the par value per share, correct. So you debit retained earnings,
Mhm.
all right, for the number of shares times the par value. And what do you credit? You credit,
Dividends payable?
no, it's not dividends payable. That's what you owe them in cash. You credit common stock distributable,
Oh,
all right? You ever heard of that account?
yes. I
Because
forgot.
you haven't distributed yet. All right. You credit common stock distributable, which is a stockholders equity account. And then when you finally distribute it, you debit common stock distributable and credit common stock at par value. Now, if you have a small stock dividend, that's when the number of shares increases by what? Less than 20 to 25%. And a small stock dividend, what do you debit retained earnings for?
The market value.
The number, yeah. If you get an 8%, all right, small stock dividend, you take 80% of the number of shares and multiply them by the fair market value per share, correct?
Correct.
All right. So we debit retained earnings at the fair market value and we credit common stock distributable at what value?
Market value. No?
Par value. All right. And what's the plug? All right. Additional paid in capital in excess of par.
Oh, my goodness.
Retained earnings is at fair value. Common stock distributable is at par value. All right. The excess, which is additional paid in capital in excess of par, is a credit for the excess of the fair market value over the par value per share.
Got it.
Okay.
Mhm.
Got it. Good review.
All right. What?
Good review.
Mm-hmm.
What? Did I remember that? I didn't hear what you said.
So good
said good
review.
Oh, good review. Well, thank you. We'll do that again. Now, what we'll do is this. Tomorrow, we're going to cover, all right, deferred tax assets. And we'll do it from 12 to roughly 2 o'clock, okay? All right. Now, we'll probably be able to cover that in less than 2 hours. But people have trouble with deferred tax assets because there's 2 types of deferred tax accounts: deferred tax assets and deferred tax liabilities, okay?
Mhm.
All right. And they have to do with what we call future taxable amounts, which are timing differences. All right. For example, if we take accelerated depreciation on our tax return and straight line on our books, what's going to happen to current taxable income versus the book income?
They're going to differ.
Higher or lower? All right. If we take I'm sorry, go ahead, Dawn.
Well, if on the books, it's going to be lower and compared to tax.
Right.
But no, if we take accelerated on the tax return, straight
Right.
line on the books, our
Mhm.
taxable income will be what? Lower
Lower.
than
Yes.
book income, right?
Right,
Yeah.
right.
But in the future, it's going to reverse itself, right?
Right.
Because, all right, in the future, when you take accelerated depreciation on a tax return, straight line the books, by the time the asset is fully depreciated, the amounts will be the same. All right. So in the current year, taxable income is what? Lower than book. So when that reverses itself after the first year, what's going to happen? What's going to happen is our taxable income will be what?
Higher.
Higher than book income, right?
Right.
Now, when you have a timing difference where taxable income in the future is going to be higher than book income, do we call that a future taxable amount or a future deductible amount? Anybody know any of this stuff?
Future deductible
A
amount.
little bit.
Future taxable amount. Taxable income is be higher in the future
Mhm.
than what? The books. Because now what are we taking in the future? Straight line is start becoming more than accelerated, right?
Mhm.
And then what's going to happen is our taxable income will become what? Higher, all right? Because depreciation on the books will become what? Did I say it right? All right, taxable, the depreciation will become less on the tax return in the future, which means our taxable income will be what in the future? Higher, right?
Mhm.
And then our book income will be the exact opposite. But in the future, when you have a timing difference, that will cause taxable income to be actually higher in the future. We
Mhm.
call that timing difference a future taxable amount.
Okay.
You ever heard of this?
Right.
Yes, yes.
And then if you multiply that by the future tax rate,
Right.
or
Right.
if you don't know the future tax rate, use the current rate, future taxable amount times that future rate or the current rate, whichever you know, gives you what we call a deferred tax what?
Liability.
Liability.
Exactly. And what entry do you make in the current year? Credit deferred tax liability and debit income tax expense what?
Deferred.
Deferred. Excellent. So there's really two types of income tax expense that make up total income tax. It is income tax expense deferred and income tax expense current. The current income tax expense is based on our taxable income for the year, right? All right,
Right.
times the current rate. The deferred tax is based on the rate we're going to pay in the future because our taxable income will be higher in the future because taxable income was what? Lower in the present day. So that reverses itself. All right. And I'll show you that. And you know something? This is not really a difficult concept. It's a few concepts. You know, future taxable amount, future deductible amounts. All right. And, you know, the entries for deferred tax assets, deferred tax liabilities. All right. It's not that difficult. I'm promising you. All right. You shouldn't have difficult. Now, meanwhile, I'm going to check this, these journal entries on page 2H27. All right, because they don't look correct. The dates don't look right to me. All right, so I'll check that. And then if you have any questions, call me in the middle of the night. I'll be up. All right, now,